want to talk to you about Treasury yields. So when we are having conversations about the market, what's going on with the stock market on a daily basis, or we're having conversations about sort of the, what we see as the potential forward trajectory for the broader market and the economy. You like to talk about the yields. And so two kind of like benchmark, yields, the 5-year yield and the 10-year yield. Can we talk about what the value of those are? And for like our more novice people, I mean, like try to take it down to like, just a 101 on Treasury yields and what people should know.
Yeah. So I mean, I'm struggling with where to start on this. So why does it matter? It matters because, I think the first thing is, it matters because a lot of our consumer borrowing rates are tied to these, the benchmark 10-year treasury. And, so mortgage debt, for example, right? So when the 10-year treasury yield goes up, the 30-year fixed rate mortgage also goes up. And along with that 10-year corporate debt pricing is also affected. Businesses want to borrow money. The bonds they issue are going to interest rate that they're going to pay for the debt is going to be very much tied to what's happening with treasury yields. Auto loans, right? And so whenever the 10-year treasury yield goes up, your lending costs as a consumer also go up. And to understand why that is, you have to understand that banks essentially borrow at short-term rates and lend at long-term rates. And so of course they borrow.
Which if I could call it just a quick timeout, one of the ways that banks make money, and banks have to make money to exist, right?
They have to make money to exist. That's right. And so when, and traditionally the short-term rate is lower than the long-term rate. And so that's the difference between the two is how banks make profits, right? Is essentially one way banks make profits. And so that is why consumer borrowing costs are very much tied to this longer term yield called the 10-year treasury yield. Now, I guess the next important thing to find out is, well, what's driving this 10-year yield? Why does it go up and why does it go down sometimes, right? Why is it that I was able to get a 2% mortgage rate 4 years ago, and then now I can't get a mortgage rate for less than 6.8% or 7%, right?
And so to set you up for this next segment, the U.S. 10-year Treasury, as of 2:30 p.m. Central Time on April 29th, is 4.172%. So yeah, contextually, that's what it is as of.
And is it going up or is it going down?
It's gone down today.
It's going down today. And, but it's higher than it's been, it's higher than it's been since, I think in early April, we had a nice big drop.
Yes. It went down to about 4%. And
that's right.
The lowest, as I'm looking at the last year. So for context, the lowest that the rate has been in the last year, I believe would have been in September, October last year, 3.65%.
Yeah, that's right.
The highest that it's been, 4.77%.
January of this year. That's right.
In January this year. Exactly right.
That's right. So what is going on here? Well, just like any other price, it's all about your Econ 101 class, supply and demand, right? The supply, who supplies treasuries? Well, the Treasury. The government borrows money by supplying bonds to be bought by the general public, by central banks, by foreign central banks, right? And so the higher our debt or fiscal deficits, the more we need to borrow money as a country, our government needs to borrow money, the higher the supply of treasuries, right? Of debt issuance. And so that's to some extent what you could say is, the higher the fiscal deficits and the higher the money the federal government needs to borrow, the more pressure there is on treasury yields to go up. And then, but of course, there's a demand for treasury yields also matter for the price, right? For those yields, demand for treasuries. And so what are some factors that influence the demand for treasuries? Well, when people, expect, the future to be doom and gloom, they're worried about the future. They thought to save at a higher rate, right? And so what do? Investors will oh, by the way, and they don't think the stock market's going to do very well, right? Because growth is going to slow. Then potentially corporate earnings are not going to be great, right? And so investors will go ahead and we call it the flight to safety. They will go ahead and buy a bunch of treasuries. The demand for treasuries goes up because it's a way to park your money in a safe place, right? While the economy goes through a downturn. And so a higher demand for treasuries will actually put downward pressure on yields, right? And so that's kind of how this works. And so why are we seeing yields come down right now? We're seeing yields come down because a ton of policy uncertainty, a lot of fear, the stock market dive, falling consumer confidence, the big drop in job openings, a very low hiring rate are all causing fear that potentially the economy could be slowing, that potentially corporate earnings aren't going to be great going forward, and that potentially the U.S. economy could be headed for a recession. And so as recession risk increases, the demand for treasuries for safe asset goes up. And so as a result, holding supply constant, right, yields go down.
I'll tell you what, I really appreciate that. That's a terrific dissertation. And I think for our audience that's just trying to figure out exactly, what it's all about and the pieces of the economy, that's one to save and one to.
It means your borrowing costs are going down, but at the same time, that usually means the U.S. economy is slowing too. And if you remember very carefully during the COVID-19 pandemic, when the Fed cut interest rates and yields were falling, people were able to get the lowest mortgage rates ever. And they took advantage of the leverage of a lifetime, right? And now you have people with very low mortgage rates. So for consumers, it's like, as long as you're able to maintain your income, you can expect financial conditions to ease, which helps the household budget constraint.
Appreciate your thoughts as always. That was a really good one. We'll catch up with you soon.